Hello my friends, Bogdan is here, and this one goes for mergers and acquisition or evaluation series, and we are going to be talking about recent acquisition of AskGamblers business of Catena Media by GIG, Game and Entertainment Group. So it is a notorious case. Recently, as most of you might know, uh, AskGamblers and a couple of smaller websites was acquired by GIG just recently, and the price was about 43 million euros for this one and a couple of smaller ones. And we want to be talking about the overall idea of this acquisition, why GIG would need this website, why the platform step into publishers' business, and what the overall logic behind it all. So we start from me saying that both companies, Catena Media, the owner of AskGamblers, and also the acquirer, GIG, are public traded companies. So they have the pressure, the shareholders' pressure on them both. And also the interesting, the multiplier to sales was about 3 times. So the the overall evaluation of the business was 3 times of the margin of sales. And it gives us two perspectives. First, why exactly this multiplier, and secondly, why would a GIG need this? So, talking about the overall idea of public traded companies and the way they would acquire or sell away the assets. So we know that publicly traded companies have the pressure of their shareholders. So it means that they would capture value at some higher point and then extract it, and then they don't need something because they want to demonstrate constantly to their shareholders that they're capturing a value of this business at the highest points ever, and they do not actually like something that's going down and the business that are stable or deteriorating. So this is one of the things that was a moving was a stimulus for selling AskGamblers, because obviously AskGamblers has passed its eclipse, and the overall price of this publishing business would only diminish in the future. So Catena Media would obviously see a lot of greater opportunities on the U.S. markets, where the return on investments would be higher than, for example, by continuing to run this publishing business in the rest of the world, targeted towards the rest of the world countries, like AskGamblers does now. So it is clear that the shareholders' pressure on Catena Media was immense, and they were obviously looking out to sell this one because it would they probably wait on the bottom line significantly. They didn't want to maintain it on the balance because the return on this asset would be much less than they have in the US, where they acquired a couple of publications also. On the side of GIG, this is another publicly traded company. This is a platform, so their business is SaaS, so they would supply software as a service. Actually, it's a gaming platform, so they would aggregate the slot machine games, the payment providers, everything here, the support and players activation stuff, all in one place. So it's actually out of the box solution that would sell to many of you who would want to start a online casino business or switch from the existing platform to this particular one. So we have them two publicly traded companies, one already established and very much renowned as a publisher, and another coming from a different domain, from a different business. This is a publisher software business that would intrude into a publishing business by whatever reason. So Now moving on to the evaluation of this business. 3 point something multiply is not that high. Maybe in previous years, some of you were also approached by Catena Media guys who would want to buy your business, for example, your publications. And this was a common practice by Catena Media 3, 4, 5 years ago. They would go on and buy different stuff on the market, I mean, different publications. So this is exactly what they valued most of the businesses themselves. So 3.5 multiplier was applied by them for external businesses that they wanted to buy. This is roughly the good estimation of SEO, so search engine powered traffic, powered publication. So maybe it's a trap because they fall into it themselves, because they valued other guys like this and they sold their own business with the same multiplier. Now, what is the actual logic behind this acquisition? So, it's not a trivial case here, and we want to discuss it in more details. And now, let's probably consider what is the business of online casino platforms. So the idea is to attract more casinos to switch to their platform, or newbies to start off with the platform in the gambling. So now this is probably much more competitive market than it used to be, where the likes of SoftSwiss and other guys which just dominate it once. And now we may observe probably 15 to 20 big platforms all over the space in the market who would immensely compete with each other for the casinos, because probably 95% of all casino operators are powered by platforms, whatever white label solutions here. So this is a good chunk of a pie, but the competition here is immense. What's the stake here? So online casino platforms would take up to probably 20% of the GGR of the overall sales of a casino operator as a fee for their services, but this fee is a percentage of sale. It's not fixed. They have a fixed also like an entrance fee and so on, administration fee, but most of the money comes from this GGR, percentage of sales. And now, is it easy for them to really expand the business right now? No, actually it is not, because the market is populated with competitors, and the most of them, like SoftSwiss, are feeling very, very comfortable. So it's not easy for them to expand their operations out of this existing business model. So they normally would look out to find another different way to attract customers here. And this is how a publication business like this of Catena Media would appear on their radar. What's economical sense behind this purchase? First of all, consider you have 20%, up to 20% of someone's GGR, and you want to somehow expand it. It's really hard to find another guy, and so on, so on, so on. When you think of Catena business, they would probably have up to 30%, maybe 35% of GGR working as a publisher. So they would mostly take money as an NGR after the fees to the platforms has been paid, and so on and so on. But they would take immense part of the earning of online casino in exchange of the traffic. So traffic is one of the most valuable assets right now, and this is and the cost of acquisition is the biggest problems in the business right now. So if someone like platform would try to address this problem right away, they get a gateway to the whole bunch of casino operators that want to expand the traffic and to get a lower cost of customer acquisition. So, for example, suppose you get this, you do this move, add up to your 20% of GGR this chunk of money, so it on the whole makes about maybe 50% of GGR for you as a single point of entry, as a provider of both software and traffic. Is it a profitable? Is it a good deal? Yes, I think it is. So my first claim is that actually GIG didn't need this kind of publisher imprint. They wanna expand the margin of operations. They wanna solidify their stance in the market of software providers by means of getting access to lots of casinos that are already clients of AskGamblers and the stuff and the sites like it. So they get access to the whole market and add up a chunk of GGR to the existing portion. So overall, it will make about 50% on the whole. So it's a good move strategically, and probably what they want to do now is that they want to try to tie up, make a bundle offer for casinos. For example, I would do like this. If they would say, okay, if you want to have the traffic from me, you can have it with 35% GGR, or you want to switch to my platform and then have a bundled offer with a discount of probably 5%. This is a good move also to start off with new ones, because new ones actually need traffic badly. They would start off with a software, but this leads them to nowhere. They want traffic. So it's a good bargaining position when you start up here and say, we give you both software and a traffic. So I think that's a good move for GIG, and this is why they actually bought AskGamblers from Catena Media. What else is here? So how the market of online casino platforms will look like right now. There's a big deal of uncertainty here. I'm not sure how online casino operators would react to this. Some of them would also switch to GIG. Yeah, this is a slow process, but it would work out somehow. Some of them not. Over the long time, the quality of publisher leads by AskGamblers would deteriorate. This is like inevitable process, because this is rest of the world traffic, and this is a profile business for GIG. So the old team would last somehow, but over the long run, these would go down. So it's only a matter of time when GIG can extract the value they need from the connections and the overall bundled offer they have together with AskGamblers, and then they need to move on to devise another things. Probably other casino platforms would mirror this move. They would try to go on the market, try to buy some guys here, but most of the publishers here are privately owned, so that they don't have this pressure of shareholders. They don't want to sell their businesses for nothing, and it's really hard to find a good deals here for other casino platforms like GIG. But over time, I think the publishers would also step into the casino platforms would also step into publishing business, because they want to mirror the move by GIG and try to also provide not only software but also the leads to casino operators. Maybe it's advice not to take this acquisition side, but also try to make strategic deals with some publishers, not buying them, but try to secure strategic partnership. Likewise, if you use our platform, say, I don't know what, Garmix and so on, you would get access to our strategic partners on the side of publishers, and you get the traffics also. But this is not certain, this is not clear. I would do like this. Now, there's another thing here that's probably called, I also referred to it earlier, it's called success theater. So many managers of these big publishers and also these casino platforms are really occupied with success theater. They want to not only talk strategy, but they want to show off the constant success on the LinkedIn, somewhere on the meeting with publisher and so on. So it also has some image implication. We are the first one to step inside the publisher business. We are the first one to go in further. Now we see the news that GIG has been supplying software to some land-based casino, no name right now, but we don't know exactly. Maybe later we'll see. So it's a more of success theater. They want to show they are the best in the industry, they are the leading ones, and so on and so on. So this is my brief analysis of the acquisition of AskGamblers. Later on, I will try to elaborate more on this multiplier of 3 and something to the sales, and try to compare the multiplier applied to AskGamblers with the same multiplier applied to different acquisitions in the business. For example, acquisitions of casino operators. I will try to make connection why casino operators will be sold with a bigger multiplier and casino publications with a smaller one. But follow me here. I'm working for you. If you have questions or comments, or you are someone from GIG or other platforms who want to discuss some stuff with me, I welcome you here. Thanks for watching. Bye.